Okay, well, welcome to our Tuesday, not every Tuesday, but about every other Tuesday, we do a live stream Zoom Q&A. Our weekly community just concluded live stream is difficult. We have our friend Brian who has his whiteboard, but we don't have, his dry erase board, but we don't only have a whiteboard. It doesn't really lend itself well to sometimes going a little more in depth. So this is capped at 10 people. You can find it at deantonytutoring.setmore.com. You go there, you register, and like I say, it caps at 10, and once there's 10, it disappears. And so, like I say, this is being recorded, and you're probably watching the replay. So if you'd like to be an active participant, you could certainly do so. It's first come, first serve in terms of also what people put in the chat that they want to talk about. And so Andy was first in the chat, and he said he wants to talk about spreads and straddles. Those are our advanced option strategies. And there are 8 testable things you need to know about a spread. I kind of joke, don't hate the 8. Don't hate the 8. And so what we need to be able to do, and what I'm going to show you, is we need to be able to identify a spread. We need to, after we identify it, determine whether it's a debit spread or whether it's a credit spread. We have to, after we do that, you don't have to do an order, but I think it's easier if you do things in a menu kind of fashion, exercise or expire. And so these are the things that you have to be able to do in a spread. We have to determine whether we want the difference in the premiums. What you're spreading is the difference. That's why it's called a spread. Spread means difference. And do you want the difference in the premiums to get larger, or do you want to get smaller? We have to be able to determine max gain, max loss. And one of the tricks about max gain, max loss is the max gain, max loss always equals the difference in the strike. So that's the whole point of a spread. And then we have to be able to do break even. And for the break even, we have 2 great memory devices. We have cal and we have push. And that stands for call, add to the lower, put, subtract from the higher. So we're going to use cal or push to get our break even. And then the last thing we got to be able to do on a spread is determine whether it's bullish or bearish. In other words, where do we want the stock in relationship to that break even? All right, so let's put a basic option position on the board, just a basic option position. I sell or go short 1 Apple December 190 call at 9. So that's just a basic option. By the way, you shouldn't be messing around with advanced option strategies until you're pretty solid on the basics. And, you shouldn't be struggling. If you are, then you shouldn't be doing anything with spreads. That this is an obligation to sell the stock at the strike price. XP means strike price. And I'll tell you when the conversation becomes testable. It's not testable yet, And I like to think of options as being about floors and ceilings. There's a floor here at 190. 190 or lower, the call is going to expire, and I'll get to keep the 9 points. I go neener, neener, neener. So as a short naked call, this is not smart. I can make 9. My break even is 199. My max gain is the premium, max loss is unlimited. You should definitely recognize that a naked call has unlimited risk. Now, what I'm going to do here would be pretty smart of me to put in a ceiling, do some construction. What I want to do here, strongly consider doing here, is offsetting my obligation to sell the stock with a choice to buy the stock. Because if I had a choice to buy the stock at the strike price, I would no longer have unlimited loss potential. The point here is, if somebody's doing a naked call, that just means they don't know about spreads, because it would be stupid to do a naked call. So what I'm going to do is I'm going to take part of my money, again, not testable. I'll tell you when it gets testable. What's testable is those 8 things that I'm going to be working on here in just a sec. But I'm going to take some of my money. I'm going to buy 1 Apple December 200 call at 2. So test question number one is, what has Dean created? I have created a spread. Test question number spread is when you're long and short the same type of contract. So this is a spread. That is test question number 1. Now, even if it wasn't a test question, I told you it is. But even if it wasn't, it is. But even if it wasn't, if you can't identify it, you don't know what to do next. Now, if we get this next part right, we can rock and roll. If we determine, for example, it's a debit spread, we're going to know debit, exercise, widen. If it's a credit spread, we're going to know credit, expire, narrow. And what we're spreading is the difference in the premium. So what I'm going to do to figure that out is I'm going to net the premiums. And so I paid 2, so that's dollars out. Some people use pluses or minuses. I like to use dollars out versus dollars in. And this is dollars in. And now I have established that this is a credit spread. It's a credit spread because we have more money out than money in. We have established that this is a 7-point credit spread. As I said, we can really rock and roll when we get that, because if it's a credit spread, we know we want the contracts to expire and we want the contracts to narrow. Goes together all the time. Another way to think of this is credit has 6 letters, expire has 6 letters, narrow has 6 letters. So 8 things. Now, once you get the menu, then you can think about it. Would you be happy or sad if I called you and said these contracts got exercised? You'd be sad, because that means you buy it at 200 and you sell it 190. Not good. If I tell you they expire, you get to go neener, and you keep the money. In fact, whenever you sell option contract or contracts, the best case is contracts expire worthless and you get to keep the money. Right? Now, I think you're kind of a jerk, by the way, if you say, well, gee, Steen, had I done the naked calls, I would have made 9 instead of 7. I said, well, yeah, but you would have been taking unlimited loss potential. I think, 7 instead of 9 is, I think, a better risk reward trade-off here in terms of what we're doing. All right, so that's my max gain. Max gain is always, the max gain when you sell a put, you sell a call, you sell a straddle, your max gain is always the money collected. Here we're selling a straddle. Actually, excuse me, we're selling a spread. Okay, so one neat trick we have as it relates to these spreads is all of the action takes place between the strikes. All of the action takes place between the strikes. So, the thing that's nifty about that is there's only 10 points to be made or lost here. All the action takes place between the strikes. Boom. So that's kind of an important concept, because when I ask you max gain or max loss, whatever these two numbers are, they have to add up to 10. It's all about the floor and the ceiling. So you can get a 50-50 on the test by when you had asked about max gain or max loss, just saying, okay, well, I need two numbers that add up to 10 because the gain and the loss always equals the difference in the strikes. There's only 10 points to be made or lost. Now in the spread, you're going to have one of these pretty quickly because if it's a debit spread, it's going to be your loss, and a credit spread, you're going to get your gain pretty quickly. So let's put that here. Boom. And our max gain and a credit spread is the net credit. And in this case, the net credit is 7. So as we said, the gain and loss always equals the difference in the strikes, which in this case is 10. So whatever these two numbers are, they add up to 10. And we already have one of those numbers, right? We have the net credit, which is 7. And so 7 plus something is 10. Now, if you don't want to do it that way, yuck, yuck, yuck. You know, I think it's easier to say that whatever these two numbers are, they add up to 10, and I've collected 7, and therefore I can lose 3. But however you get there, you need to get there. Now, if you don't get that, then, you know, if you don't get that, then you got to memorize. And the more things you have to memorize, well, I just think that's a problem. But if you don't get that, then you're going to have to memorize that the maximum loss in a credit spread is the difference in the strikes less the net credit. I just think that's a mental mess. I think it's easier to know that there's 10 points to be made or lost. All the action takes place between the strikes. I've collected 7. I can lose 3. By the way, making 7 and losing 3 is a much better risk-reward trade-off. Right? This is a sign that, you know, somebody who does a naked call is stupid. Because why would you want to do a naked call and make 9 and lose unlimited sums of money? So, you know, the break-even, we know the break-even's got to be somewhere within the range. So test taking trick. We know the break-even is somewhere between 190 and 200. You know, it's somewhere within there, right? So you can eliminate on the test any choice that isn't somewhere between 190 and 200. That alone gives you a 50-50. So for example, if you're offered 202, you can get rid of that. If you're offered 188, you can get rid of that. It's got to be a number that's between those two. Now, a good way to remember this is CAL, and that stands for call, add to the lower. Call, add to the lower. So we're going to take the lower strike, which in this case is 190. We're going to add the net premium. Doesn't matter whether it's a debit or credit, doesn't matter. In this case, it's a credit, and we're going to add that, which in this case is 9, or excuse me, 7, and we get our break even of 197. And then the last thing we got to be able to do is determine bullish or bearish, and test question. The larger premium dominates the position. The larger premium dominates the position. So the larger premium here is a 190 call at 9 that we're short. And so test question, this is a bearish spread. If you do my 9 things, whatever they want to know, you've got the answer. I call this don't hate the 8. There are 8 things you need to know about a spread. Can you identify a spread? Let's just reset. Can you identify a spread? A spread is when you're long and short the same type of contract. Can you determine debit or credit, exercise or expire, widen or narrow? And the way you do that is by netting the premiums, because that's what the spread is. The spread is the difference. So we net the premiums and we find out we got more money in than out. This is a credit spread. Whenever you have sold a spread, credit, right? Whenever you sell a call, you sell a put, you sell a straddle, you sell a spread, the max gain takes place when you agree to be a potential victim. Nobody victimizes you, and you keep the money. You get to keep that 7 points there. Woohoo. Hardest part is narrow. Narrow means the difference in the premiums. if I can close it for 5, I'm going to make 2. If I can close it for 4, I'm going to make 3. I need the difference in the spread, the difference in that to get smaller. Hardest part to get, don't need to get it because credit expire narrow goes together all the time. So we've identified it, credit expire narrow, we got our max gain. The gain and the loss always equals the difference in the strikes. So test taking trick, you can eliminate anything offered to you that doesn't add up to 10. Whatever these two numbers are, they add up to 10. Of the two numbers, you already have one of them. So 7 plus something equals 10. Again, if you don't get that, then you got to memorize, yuck, that the maximum loss in a credit spread is a difference in the strikes less the net credit. I just think that's a mental mess. You have to do your break-even cal or push. Cal stands for call, add to the lower, put stands for put, subtract from the higher. And then you have to do bullish or bearish, and the larger premium dominates. So those are all the things you need to know about spread. I think straddles are a little more straightforward. Straddles are 4 things you have to be able to do on a straddle. You have to be able to identify a straddle. You have to be able to calculate the break-evens. The break-evens. This is the only strategy in which we have 2 break-evens. And the way we're going to do that, call up, put down, call up, put down. We're going to take strike price plus total premium. And that will give us the upside break-even. And we're going to get, boom, let's put that a different color. And that'll be our upside break-even. We're going to take strike price minus total premium. And that will give us our downside break-even. Boom. The third thing we got to be able to do on a spread is we have to determine where is the spread, or excuse me, where is the straddle profitable? Where is the straddle profitable? We have a great memory aid device for where straddles are profitable. Where is the straddle profitable? And that mnemonic or memory aid is SILO. SILO. And what SILO stands for is short inside, long outside. If you're short a straddle, we're going to want the market price to be in between our 2 break-evens. And if we're long, we're going to want it outside of our 2 break-evens, SILO. And then the last thing we got to be able to do on a straddle is when do we use it? When do you use a straddle? All right, so let's put a straddle up here and take a look at it. All right, so we'll use Apple again. Now, Apple has come up with these new virtual reality headphones. I think they're like our iPhones. I don't know what they are. They're goggles, right? And I think they're like $4 or $5 grand. And to be honest with you, I'm not sure if they're going to be a hit or not. My idea here is that if it's a hit, I think the Apple stock could move much higher. But if it's not a hit, I go, I think the stock could move much lower. So, if I just thought it was going up, I'd buy a call. And if I thought it was going down, I would buy a put. So here I'm going to, Jackson, nobody has seen Pro Golfers Don't Miss in years. It drives me nuts that people are still sharing pre-sale group designated member orders when it hasn't been tested in years. So make sure when you're using memory aid devices, you're using one that is current. I get all the time, my most popular video on is, tips and tricks and memory aids for the Series 7. And a lot of times, Jackson, I get a nasty comment. You miss Pro Golfers Don't Miss, or pretty girls date more, or pretty guys date more, whatever your sexual preference. How'd you forget that? I said, I didn't forget it. It hasn't been tested in years. So a waste of your memory space. All right, back to what we're doing here. So I'm going to go long or buy one Apple December 190 call at 6. If I just did that, my break-even would be 196, my gain would be unlimited, my max loss would be 6 points, and I'm bullish. But again, I'm going to do both. So I'm going to go long on Apple, December 190 put at 6. So test question number 1, can you identify it? Is it a spread? Is it a condor? Is it a butterfly? Is it an alligator? Is it a flamingo? What is it? It is a straddle, right? Even if that wasn't a test question, I just told you it is. But even if it wasn't, I just told you it is. If you can't identify, you don't know what to do next. You know, some people are visual people, so let's put a visual representation. You know, here is the market price of Apple. You know, how far up could Apple go? There's a finite supply, potential infinite demand. What we're straddling is the strike price line. We're straddling the strike price line, which in this case is 190. XP means strike price. Right? So that's what we're straddling. So we've identified the straddles. So now we got to calculate the break-evens. We're going to have 2 break-evens. We're going to have a downside break-even, and we're going to have an upside break-even. It's the only strategy in which we have 2 break-evens. And so the way we do the break-even is we're going to combine the premiums. We're going to combine the premiums. You know, we're out of pocket a total of 12. You know, if I really wanted to teach you options, I'd make you buy one. And once you were out of pocket, you'd figure out pretty quickly how this works. But our break-even test question is going to be 202. That's our upside break-even. And 190, I'm going to use my calculator. I'm not being facetious. I'm terrible at arithmetic. So I'm going to take 190 minus 12, and 178 is our downside break-even. And then we said, what we got to be able to do is determine where it's profitable. Where is it profitable? Silo. Short inside, long outside. I want Apple to be above 202 or below 178. I need to be outside of that. I certainly don't want it in between these 2 numbers. That would be bad, right? I don't want it in between here. I want it outside. You know, the worst price would be 190 at expiration because I lose my 12 points. So that would not be bueno. And then we said the last thing is, when do we use it? So we buy a straddle when we're expecting volatility. We buy a straddle when we're expecting volatility, but direction is uncertain. All option speculative strategies, you're either buying volatility or you're selling volatility. And here we're buying non-directional volatility. You know, a straddle I did, this was a public company going into court. And I thought if they lose the court case, the stock is going to tank. And if they win the court case, the stock is going to roar. So I bought a call and a put. You know, I got to build a mistake on one of these. I'm hoping one of them comes through for me big. Another straddle I did was a company that hired a new CEO to fix their problems. And I don't know if he's going to fix the problems and the stock's going to go up, or he's not going to fix the problems and the stock is going to go down. What do I care? Just as long as the stock moves. So you use a long straddle when you expect volatility. Now, again, we have 2 versions of this. We have long straddles and we have short straddles. We have long straddles and we have short straddles. So I say, do you think Apple is going to stay between 202 and 178? Because if so, there is a way to profit. And same test questions. Can you identify a straddle? Can you calculate the break-even? Same break-evens, long or short, just a matter where you want it in relationship to that. And then short straddles are kind of dangerous because, you know, you have a naked call there. And so this thing, you know, can go, you know, move against you quite rapidly. You don't get killed on the put, but you certainly can get killed on the naked call that's up here. Those are tiers. Here's. All right, so let's see now what else in the chat. So that was Andy. We did a straddle, we did a spread. Trina tips, Treasury inflation protected securities. What you need to know, Tina, about a tip, and I think, again, you can go into the search bar on my channel, put in tips, and you can see me 5, 6 times doing practice questions with people struggling on tips. And I get upset with the test prep vendors because on the actual exam, it's much easier. You know, if inflation is 8% and I have a tip, I'm going to get my principal adjusted upwards semi-annually. That would be 4%, $40. So how am I getting that? 8% of 1,000 is 80. Half of that's 40. So 1,040, then times 4% again. And by the way, if you get practical application on that, you don't even need to do the math because it compounds. So you can just do simple. Like if I say 2 years at 8%, that's 160. And then I just pick the answer that's something north of 1,160. There'll only be one that's like that. And so you can just do it that way. But you should know very testable keeps pace with inflation. So it's going to be adjusted by the CPI. Cynthia, taxation and cost base is just, you know, really, I mean, it's what we got 20 minutes left on what, so, that's a huge concept. I will link to a video where you can find a video. Again, go to the search bar of my channel, put taxation, and it says death and taxes. No, just death, and there's a whole video on the tax consequences of investments on each and every investment and how you're going to get tested on that. The basic idea here, let me just do the basics. The very basic thing on the test is that when I turn my money into the stock, so I buy 100 shares of Apple at 193. That is my cost base. Cost basis is simply when I turn my money into the investment, right? So here my cost base is 193 per share. And then the idea is at some point, I'm going to turn my money back into the investment back into money, right? At some point, I'm turning this back in to money, and that's called my sales proceeds. And so if I sell the Apple for 210, let's say, 190 is my cost basis, and 210 is sales proceeds, right? And I'm going to have a taxable gain here. And here the taxable gain is going to be 17 points. Test question, that 17 points or $1,700 is either going to be taxed as a long-term gain or a short-term gain, depending on how long I've been at risk. If I've been at risk for more than 12 months, it's going to be a long-term capital gain. And long-term capital gains rates are lower than short-term. Short-term is going to be taxed at my ordinary income. Now, I'm not going to go into all kinds of questions about cash dividends are taxable, stock dividends are not, adjusting your cost base for a stock split or stock dividend, converting is not taxable. Going from fund A to fund B is, FIFO versus dollar cost, average share cost. There's all kinds of test questions. So again, it's not target rich. There's not a lot of them, but there's a lot of content there. A lot of content. Most target rich knowledge questions. I told you function 3. I just finished a tutoring session today, and we were going through function 3, Jackson. And sometimes when I'm tutoring people, I'll say, man, it's been a great tutoring session, you and me. We did a great job today. Would it be okay if I share your tutoring session with others? Sometimes people say, no, Dean, it's my private business. And, I don't want to, I let you record. And then if you give me permission, I said, well, give me the recording back. Right. So anyways, good news. She gave me permission to post our tutoring sessions. And what we did basically is we went through function 3, the 91 questions in function 3. So you want to stay in function 3. And then in function 3, the biggest areas are options, munis, and mutual funds. And so I'll be posting that soon, but that's what I would tell you. And then I have lectures. The other playlist I have, Jackson, is called Your Vendor Lectures Are Not Working For You. So if you go to that playlist, I have lectures on equity securities. I have a lecture on bonds. I have a lecture on munis. I have like 3 or 4 lectures on munis, as a matter of fact. I have a lecture on variable annuities. So you can check out that playlist if you'd like. in terms of those target-rich environments. I also have a playlist called tutoring class coaching called replays. And I also did some classes, and you can watch a replay of my class as well on some of those things. Memory tips for what's in a prospectus. I don't have anything for memory tips in a prospectus. I would know it's basically everything you need to know to make an informed decision, all the material facts. Munis are exempt from prospectuses. They use the official statement, but same general idea. The memory aids I would tell you that I have for you are found in my video called Tips, Tricks, and Memory Aids. You know, we have DERP in there and Silo and Cal and Push and all those various memory aids. Cynthia, I'm not sure what you want to know about 1035 exchanges. The basic thing is they are not taxable. And I'm not sure, I've been working all day long. The thing I would know is I think you can't go from annuity to life. I think there's one where you can go annuity, life to life, but I don't think you can go to annuity to life. Knowledge questions, well, those aren't knowledge, those are recognition. The 3 styles of question, Jackson, are recognition, practical application, and judgment. And you can't be giving up recognition questions. That's simply stuff you know or you don't. Now, test prep vendors don't give you context, but the test will. They'll send a rule G20, the gift or gratuity rule, and then you got to know that's $100. It doesn't count normal deductible business activities. You know, G37. The maximum campaign contribution you can give to somebody can vote for is $250. So they'll give you that. I think, Cynthia, I just did a credit spread. Didn't we just spend the first 30 minutes doing a credit spread? Oh, you were identifying it. Oh, thank you. So I think, Cynthia, we're answering the first question. Worthwhile members, there are tons of online. I told you, I don't care what other people tell you. I care what I'm telling you. You got to take a voice. I just told you that's not testable. So, and nobody has yet called me and said, you told me it's not testable, it's testable. But, you know, you can watch a video podcast I have called Legacy Test Questions. And you're going to get me going on a rant here. And my rant in that podcast video is test vendors don't ever call their queue back. I get it because they don't want to say they have less questions. So they never remove things that aren't tested anymore. I call them legacy questions, like nobody's had to do a mill rate in forever. You know, nobody's had to quote do yield to maturity. So I go, now I get it, even on my channel, right? I've been at it about 3 years now. And, you know, I have a practice test I put up 3 years ago. And people say, well, gee, Dean, is it still relevant? I go, yes, it's relevant, or I would take it down. But even if it wasn't relevant, I go, man, I got one less practice test, right? No, so nobody wants to say they got less, right? Yeah, options are 20 plus questions. So there is no exam in which you can blow off options pass. If you're going to blow off something, blow off margin, blow off partnerships. If you tell me you missed a mark on 7 because of partnerships or because of margin, I'm going to say, I don't believe you. But if you tell me that you didn't know what a call or put is, and you didn't know options, that's a serious problem. You know, and there are 9 test questions on 9 option strategies. All right, Dean's working out with a net here right now, so be patient with me. I'll probably regret trying to do this, but I think I can do it. Let me see if I can do this. Here are the 9 option strategies. You are held accountable. I know it's not on the screen yet. Give me a sec. I'm trying to get better at being able to navigate, you know, these shared screens and things like that. And boom, 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 boom. Boom. Okay, let's see if this works. Let me get you guys back. Can you guys see that screen? Yes, no?
Yes.
So those are the 9 option strategies on the Series 7. Long call, short call, long put, short put. Now, the vast majority of your questions on the exam, as it relates to options, are the basics and a covered call. That's where the vast majority of your questions are going to come from. And as I said, you do get advanced option strategy questions. You know, the reason I have this menu here is because I think people think there's a gazillion things that they get tested on, and there's not. These are the 9. You know, how do you protect a long stock position? How do you protect a short stock position? how you generate additional income. So I think it was Nico today, and he was asking about a covered call versus long put. And I think I told him, this is a much bigger deal. This is 4 or 5 questions here on covered calls. A protective put maybe 1, right? But in total, this is going to be, 20 plus option questions, right? And then I told you here on the spread, we just did a spread and we said there's 8 testable items about a spread. And here we said there were 4 test questions about that they can ask about straddles. Right, on all these, you need to know break even, max gain, max loss, bullish or bearish. By the way, I think you can find this in my one of the when I start the option lectures. A lot of times I start by laying this out. By the way, in my playlist, this is video 1, basic options. This is the second video in the playlist. Video 1. I should have been video 1. My bad. So video 1. This is video 2 in the place. These are the first 3 videos in the options playlist. Right. And you can watch those as either class replays or you can watch them as lectures. Okay, let me go back to chat. Get rid of that. Okay, chat. Let's move the chat. Call and put. We got that. On the in question. So, Jackson, I'm not sure what video is FIFO versus LIFO. Andy, I have an entire video on LIFO, FIFO. You can put it in the channel search bar because it depends on the context of what you're being asked. For example, in a variable annuity, capital IDs, yeah, sent that to me, Cynthia. And like we did, I think we did a whole bunch of them that you had come up with, and we'll do more. If you have a Kaplan Q bank, you can just send me QIDs and I can see what you're looking at, right? Anyways, on this one, let's just go over that quickly. But Andy, I do have a whole entire video on that. Let's go with the most common version of this. The most common version of FIFO and LIFO, or I should say high probability, is knowing that in a variable annuity, it's going to be LIFO. In a variable annuity, when you start getting distributions, last money's in, our first money's out. So that's one version of a FIFO LIFO. Another version of this is, how do broker dealers assign exercise notices? They can do a random, FIFO, or another fair method. Another version of this is tax consequences of investments you've been buying over several time periods. And so now you're selling. And when you sell, Andy, what you like to be able to do is share identification. But if you can't do share identification, the IRS is going to impose upon you FIFO. Very low probability. Last version of this is inventory. When I'm selling my inventory, am I using first widgets in, first widgets out? Or am I using last widgets in, first widgets out? Now, if I'm using the first widgets that I bought, and those are the ones I'm selling, I'm typically going to have a lower cost base on the earlier widgets, and my margin would be better. Whereas if I'm going to use last widgets out and to inventory first widgets out, those are typically ones I paid more for, and I would have a smaller profit margin on it. So those are all the LIFO, FIFOs that show up on Series 7. I have an entire video on just LIFOs and FIFOs. The in question explanation, the actual test is huge. There you go. Exam FX, I told you, is pretty thin. So I'm not really, a big fan of Exam FX and training consults. Okay, well, it looks like we covered everything. Anybody got any more? I think that's the end of the chat. Did I miss anybody? You can unmute if I missed you. If you have anything else on mute, just tell us what you want to talk about. We'll knock it out here in the last couple minutes. No? Okay, well then remember, inch by inch, your Series 7 is a cinch. Yard by yard, your Series 7 is hard. I've already put up the next overtime session. What I typically do is put this one now as a replay for next Tuesday. And I say, hey, if you want to see what we do in the overtime session, there's a video posted, and then I'll post that next Tuesday. And then I do the following Tuesday, we do it live. So what I'm doing now in the rhythm I'm in is live, replay. So we're doing these every other week. All right. Anything else? Okay, everybody. I'll see you next Tuesday for the live stream. If you do purchase a course from me, then you're entitled to free office hours as well. And if you purchase tutoring or a class, I put those up and you can access those. That's not for somebody who hasn't spent any money. This is completely free. You don't have to spend any money to participate in this, but to participate in the office hours, you have to be a paid student. All right. I think some of you I saw are on that office hour. I moved that from Wednesday to Friday because I always tell you these free stuff gets knocked if we have somebody who wants to pay some money, right? So, Wednesday, somebody at that time wanted to get some tutoring. So I knocked the free one off to Friday. So we'll do it Friday. See you then. All right, everybody. Bye-bye.